Welcome to our LATAMPaper April 26. World demand is under pressure. Energy costs are pushing increases due to wars. The global economy enters Q1 2026 on a resilient but visibly weakened footing, caught between steady demand and a widening risk premium. The OECD projects global growth of 2.9% in 2026 and 3.0% in 2027, with US GDP at 2.0%. The euro area at 0.8%, and China slowing to 4.4%, a trajectory softer than pre-conflict expectations after the energy supply shock triggered by the escalating Middle East conflict. Headline inflation across G20 economies is now expected to run at 4.0% in 2026, reflecting the surge in global energy prices, effectively delaying the last mile of disinflation and pushing the Fed into a more cautious stance. Markets now expect only 2 additional cuts to a 3.00% to 3.25% range. Demand is split along a K-shape. AI-driven CapEx and tech sector investment remain the dominant growth engine, while labor markets are cooling and middle, lower-income household spending moderates under sticky prices. Corporate sentiment has actually improved modestly, with customer demand, rather than tariffs, returning as the top operational concern for the first time since late 2024, signaling that executives have largely priced in the new trade regime and are refocusing on growth execution. Geopolitically, Q1 is the most contested quarter in years. The WEF's 2026 Global Risks Report flags uncertainty as the defining theme, with 50% of surveyed experts anticipating a turbulent or stormy outlook over the next 2 years, a 14 percentage point deterioration versus last year. Latin America enters Q1 2026 with subdued momentum and cautious business sentiment. The World Bank, in its April 8 update, trimmed regional growth to 2.1% for 2026, down from 2.4% in 2025, citing high borrowing costs, weak external demand, and inflationary pressure from geopolitical tensions. Consumer behavior is moderating across Brazil, Mexico, and Colombia under accumulated cost of living pressure and stagnant real wages, though resilient labor markets and targeted fiscal support are keeping consumption at a solid pace. Election cycles in Brazil, Colombia, Peru, and Chile inject FX and policy volatility that will keep corporate CapEx on hold through the quarter. On the export side, the picture is bifurcated by commodity. Fruits, vegetables, and flowers remain a structural bright spot. Ecuador flower exports peaked around Valentine's Day with sustained US and European demand. Mexican avocados, berries, and tomatoes continue dominating US fresh produce imports, despite USMCA renegotiation noise. And Peruvian and Chilean fruit, blueberries, grapes, citrus, ride strong Northern Hemisphere off-season demand.
Unfortunately, the pressure on energy is wreaking havoc across the industry. The impact on inland freight and logistics costs has been immediate, and the cost of chemicals used in the process has also gone up. All of this has forced the mills to raise their prices on these grounds. Most markets have accepted the increases. Only a few are still holding out where we haven't been able to push them through yet. On the other hand, global demand doesn't seem to be improving, which is opening up gaps that will start showing in the short term. The World Cup has given demand a bit of a lift in certain countries, but it's strange that in the host countries themselves we're not seeing the same dynamic. Pulp. The pulp market is clearly moving at 2 different dimensions right now. Softwood keeps losing ground while hardwood is holding steady. Softwood is under pressure from every angle. On the supply side, the Chinese are bringing an additional 1.5–2.0 million tons of domestic BSKP online through swing lines, thanks to better availability of local softwood chips. Hardwood is on a defense position. China will determine if hardwood turns into a downward trend soon.
Thank you for watching. See you soon.